Today is Wednesday, May 17th, and welcome to this week's In the Know Trader Show. Our question for you: has the easy money already been made? This is something you've got to ask yourself each and every time you're looking to get into a trade, especially if you're buying into strength or selling into weakness. So we'll get into that in a moment. First, I want to remind you of the products that we have at In the Know Trader. We have a weekly ETF Tactical Trader Report, usually comes out on Thursdays, and the report goes over the macro landscape. Everything that affects the U.S. stock market is reviewed. So we do a deep dive into the bond market, credit spreads, the U.S. dollar, often gold, sometimes oil, anything that we think has a major impact on the price of the U.S. equity market. We give you a rundown and go into the charts of what each one is saying. And then we do a deep dive into the S&P 500 itself, the key levels, what direction I'm looking for it to move, both in the short and medium term. Then I give you a brand new ETF trading idea each week, as well as review every open position we have until it gets closed out. So again, that comes out Thursdays. And for anyone who's trading the markets, this is something that you're going to want to have as support to how and when you make the decisions that you do. We also have a monthly report called the 7-11 S&P sector ETF report. The goal of this report is to outperform the S&P 500. So this is not for traders. This is more for investing. And the goal is to outperform the S&P 500. And I do that by being in no more than 7 of the 11 SPDR macro ETFs at any given time. So you know there are 11 sectors to the market. Each one of those sectors has a SPDR ETF, like XLK, which is technology, XLF, which is financials, and so on. Those 11 sectors in their proper weighting compose the S&P 500. If you invested in all 11 of them in their proper weightings, you'd get the same return as the S&P. Or, of course, you could just buy a SPDR, much simpler to do. However, when you buy SPDRs, you are getting the average return of the S&P. Our goal, like most active money managers, is to actually outperform the S&P. However, very few can do this over time. And here's the statistics right in front of you of how we've done. So in 2022, we outperformed the S&P by just over 6% by being able to be in the right sectors at the right time. That's a huge outperformance. In April, we outperformed by 12 bips. We're only up by 13 bips this year. Obviously, this is a much tougher year. And historically, and this is really what's important because this, again, is for investing over time, this 7-11 report has outperformed the S&P by 13.14% in the 33-month history that it's been around. So in just over 2.5 years, you would have an extra on, let's say, a theoretical $100,000 account, you'd have an extra $13,140 in your account because you followed what I instructed you to be in, which sectors to be in at the beginning of each month. Results like this put us in the top decile, if not the top 5% of all money managers out there. And again, I'm not managing your money. This is something you're doing yourself. This is a market letter to subscribe to. But if you followed that easy step once a month, you'd have an extra $13,140 in your pocket. Something to consider when you think about how much money you might have sitting in SPDRs or similar type passive funds. If you're watching this, you're probably watching it on my YouTube channel. To subscribe to it, go to youtube.com/inthenowtrader, hit the subscribe button, and then each time you open YouTube, my most recent videos will be right on top on your homepage. Follow me on Twitter at InTheKnowTrader. So let's go back and talk about this question that I've posed to you. which is, has the easy money already been made? So think about this. You look at a stock that, let's say, bottomed. Here, let's just think about it in the sense of the market. Most stocks bottomed in October of 2022. Market's been moving higher steadily since. And, it's had some sideways action certainly this year, but it's a decent pop off of that October low. If you buy a stock now, ask yourself, or just before you buy the stock, or you're contemplating buying it, has the easy money already been made? Do I have significant upside at this point, or am I buying after the bulk of the people who are going to buy the stock have already bought? Now, we can't assume that the S&P is going above 5,000, and this is for both a trading perspective and an investment perspective, depending upon which way and what you're doing. Is this your trading account or is this your investing account? They should be completely different accounts. But either way, you kind of want to have a sense of, has the easy money already been made? And if you're not sure what I'm talking about, let's use charts to help here. So let me go pull up, for instance, a chart of Meta, the old Facebook, which has been on a huge move since it bottomed last fall. And the question I ask you is, if this bottomed right near $90 a share, and now it's trading at $240 a share, even though it has a straight up move, has the easy money been made in this name? And I will suggest to you that it has. So how do I come up with that? Simple analysis here. Notice I don't have complicated models. You may not be familiar with the DeMark model here called sequential, and I'll just touch on that for a second. But let's just look at the very basics of something that you can do yourself. Where did this stock break down from? Well, I'd say there are two main places it broke down from. The first would be somewhere in round numbers under 300 last year, when it broke this pattern here, which is a minor head and shoulders type topping pattern. It cracked. And this, of course, was missed earnings and completely fell apart. In that week that got demolished, it also closed less than these two double bottom prior lows from earlier in 2020 and early 2021. We have now come back to the first of those two breakdown levels. Now, when the downtrend line got exceeded about a month ago, you can see there was a surge in price as certain people got stopped out, as this prior high here of 236 and change got taken out, and you can see some buy stops were probably run, only to see this now mark a setup 9. Again, this is part of the DeMark sequential model. That's 9 consecutive price bars, in this case 9 weeks, because we're looking at a weekly chart, that the closing price was above the closing price from 4 weeks prior. And when you do that 9 consecutive weeks, or the inverse, 9 consecutive Friday closes that were less than the close from 4 weeks prior, you often get a pop in the other direction. And you can see off of this 9 count in February of 2022, we rallied straight up for a month. You can see that the low was made 1 week after that pattern came in. Now we kind of have it in the opposite direction. Certainly from a pure timing point of view, a natural place for this to pause. Then when I look and see that this is also against prior resistance, this is more of a reason that we certainly could pause. So I ask you the question of the week. Has the easy money been made here? Is this the time and place to buy Meta? Now, apparently it is for some analyst on the street in the last week who just upgraded this stock, missed the entire rally, and now some, I don't know, 150 50% gain off of the low is first telling clients to buy Meta. To me, total joke, unreal that somebody who gets paid to do this professionally is first now deciding that Meta is okay to come back into. That's part of the reason I've actually reduced some of my holdings up here in Meta. And I was fortunate to get long right around the $90 level for a variety of reasons at the time. So I've taken some off within the last few days, part of it being the push through the downtrend line from a month ago, which you can tell from that type week, brought in new buying. And the buying, again, could be shorts covering. And certainly there could be plenty of shorts that were in this name for the last year. Some new people coming in. Now you've got an analyst who's upgrading, and why somebody who's certainly a professional on the street would very unlikely be putting money into Meta because some analysts now finally decided to upgrade it. But there's always going to be some retail individual investors who are going to listen to this and come in. To me, the easy money has been made. It doesn't mean Meta can't eventually get up to $300. But I would say to you that from this neighborhood, let's call it 240-ish, that you have as much chance for this to come down. And in fact, here, let's draw an uptrend line and just see even where would the basic uptrend line come in. And that's the proper way to draw it. So right now, you're talking about it could easily pull back to 200 as much as it maybe in a bull market scenario, which is certainly still very questionable whether or not we're going to continue with it as the S&P stalls every time we get to 4150. Does it pay to buy this, or has the easy money been made? I will suggest to you the easy money has been made. Now buying the stock is going to have a much more difficult time making money at the same pace that you have in the past. Doesn't mean it couldn't go higher. It means, to me, this is not the right time or place to buy this name, regardless of the fact that it may ultimately go higher. There's no way, no how I would be buying this name up into this 240 neighborhood against prior resistance and with a setup 9 count like we have. I could be a buyer on a pullback, and if in a month or two, maybe we come and pull back here into just north of 200 where these two trend lines meet. Now I have the uptrend line to buy against. I have a pullback to the downtrend line. Much better reason for me to buy down near 200 than at 240. As far as I'm concerned, the easy money has been made. Let's take a look at something else. Here's Bitcoin. And I don't often do a whole big analysis into Bitcoin. I still think the crypto space is a very iffy space to trade, but certainly lots of people do. And to me, so here's going back a few years. Up here on top, this is the all-time high in Bitcoin. These are futures, by the way, the Bitcoin futures market, which trades just like regular Bitcoin does. But anytime there's a futures market, I'm going to use that as my pricing rather than the underlying. I've said this on prior videos I've done for both in the No Trader and other places that I do some videos for. The week that made the lowest low in Bitcoin was the week that the FTX news came out last November. And if you see how low Bitcoin went, so it went down to 14,925, and it never traded beneath that. So in late last year, I was telling clients, if you're going to pick a way to play Bitcoin, this is a time and place that you can be long, and with an appropriate risk on the downside that we could stop out under 13,940. So let's say you were risking about $2,500 in order for it to at least go back to 25,000, the prior and last high before the lowest low was made. And it did exactly that, pulled back, filled the gap in here, then the next week gapped higher, and has now brought us into this whole zone that I've got in this blue ellipse. And I'm going to say the easy money has been made. Why? Because let's take a look. Where did Bitcoin break down from? Well, you had multiple lows in the past at this level, which is just about $29,000. It even came to it back in May of last year, got beneath it, but closed above it, spent a month there before breaking down again. So that was kind of the last breakdown point. What's the highest high it got to when trying to hold that level? That's here at 32,455. So these two purple dashed lines are a major inflection point on this chart. Lots of people trapped above. If it gets above it now, shorts who sold underneath are going to be trapped. So this is kind of a key place. And you can see that as of about 5 weeks ago, this got as high as 31,200, right into this zone. I even extend the zone up to the bullish propulsion exhaustion level at just north of 35,000. This whole area is virtually an impossible place to play where the odds are in your favor of making money 6 months later. You just don't know which way is this going to go. The easy money, and I'm not saying money is ever easy to make in the market, but the easy money has been made being long Bitcoin off of the lows. So we've gone from, where did we say that was? 14,009. So let's call it from 15,000 up to 31 and change, a doubling in price. The easy money has been made. Putting buying it now or selling it now is much more difficult to know which way to play. But certainly buying it now puts on inordinate risk relative to where, again, the uptrend line is. If we pull back to the uptrend line, depending upon how quickly it would do it, you'd also potentially fill this unfilled gap. So that would be a better place to buy than paying the current price of 20. What is that, 26 or 28? I can't, my eyes can't make out. It's 26 and change. Then, is that right? Yeah, 26,850. So I would say the easy money has been made in Bitcoin, and you've got to, if you're going to be a buyer, you really have to find a support level that makes sense as compared to just buying within the trend like so many people do. So this has been two examples of easy money's been made on the upside and much more questionable. Meta, much more questionable if you should be paying $240 now than any time in the past to get long. Bitcoin here at just shy of $27,000, much tougher. The easy money's been made. Let's look at one more example of this concept that you should be asking yourself each time you make a decision. And I understand that you may not be trading this market, but here is, that's not the chart I wanted. Let me see. Here we go. Here is a chart of natural gas. And so natural gas, of course, is a major part of the energy space. Oil is a bigger part. But if you are trading XLE, the S&P 500 energy sector, you need to know both what oil is doing and what gas is doing. So natural gas had a huge move up last year in the a lot of it because of the Russian-Ukraine war and the supply shortage that got to Europe. But it eventually peaked. And notice the two highs were made on both sequential and aggressive sequential 13 counts. We then sell down to a 9, get a good bounce off of the 9, and then sell all the way down to just in and around the neighborhood of $2 from what was as high as almost $10 last year. Massive decline. We now have aggressive 13 downside exhaustion signal, standard sequential downside exhaustion signal. We are above the 20-year lows, which were at about $1.50 or so. Let's see, where's that line? $1.52 made a couple of years ago. I will suggest to you the easy money on the short side of natural gas has been made. Doesn't mean it can't trade lower. But given that we've got essentially the opposite signals of how this topped, I'd say to you to first get short natural gas down near $2 is a very difficult way to play this market in order to make money. I don't say that it has to rally, but I would tell you that the easy money has already been made in this market. So if I was going to make a decision on which way to play this, I would lean far more towards going long than going short. The easy money has been made already being short. Any money you're going to make now being short is tough money. It's not going to generally come quickly. You can see we've already spent a good portion of 2023. We're 5 months in, and we're kind of in a range between $2 and $3. So at $2.34, where it is now, there's not much to do. But selling it, you have, I'd say, less chance of making money on it than buying it. And I'm not telling to you that you should go out and buy it. What I'm telling you is when you look at this chart and you do some very simple analysis, the easy money has been made already, in this case, on the short side. And shorting at this time and place is not likely going to yield you anything like it has yielded you in the past. So that's what I want you to do each and every time you're looking to put on a trade or an investment. Look at your charts, look at prior support and resistance levels, look at if you have access to any timing models, do your analysis, whatever you use, your cloud charts, Bollinger Bands, doesn't matter, whatever analysis you do, take a look and think, am I getting into this idea too late? Has this already worked for so many other people that I actually could be the reason selling it, that somebody gets to cover their short and they buy from me as I'm still trying to sell? And how much can I make on something like this as compared to what's already happened? Has the easy money been made? That's it for this week. I hope you liked this video. I'm Rick Benson, and this has been In the Know Trader.